A key skill for any investor is how to analyze an investment trust. In this video, we're going to do exactly that using the example of the Scottish American Investment Trust, which has the ticker SAIN. We're going to look at some of the key metrics, such as the objectives of the fund and how it might fit with your portfolio or investment style, the performance of the fund over time, whether it has prolonged and deep losses in value or not, the fees that the fund charges, including the performance fee, a long look at the portfolio, how diversified it is, how consistent it is with the objectives of the fund, and whether there's some good evidence of risk management. We'll also look at the people running the fund and the parent company behind the fund, their tenure and expertise. Scottish American Investment Trust key facts. It's been managed by Baillie Gifford since 2004. The current managers are James Dow and Toby Ross since August 2017, so quite good long tenure there. It has a Morningstar analyst rating of bronze, which is pretty good because not many investment trusts have that. The ongoing charges fee is 0.59%, which is lower than quite a few equivalents, including Fundsmith. It has an open-ended investment company equivalent of the Baillie Gifford Global Income Growth. We've got the full aims of the fund on the left here, but in summary, the fund aims for income growth in excess of inflation, and it's going to do that by holding quality compounding companies, compounding dividends and earnings, and holding that alongside property, infrastructure and bonds, and the equities it has will also have capital growth potential. It also wants to avoid cyclical and capital intensive companies. So it seems like a pretty good aim, although it doesn't draw out enough, I think, a benchmark it wants to beat. These are some key performance stats of the fund, and again, you might want to pause the video here, but in summary, the fund has beaten its benchmark in terms of total returns. It's also been able to grow dividends in excess of the consumer price index. For the equity part of the portfolio, we've got the top 10 holdings here. The investment trust is overweight Europe, consumer staples and industrials, and underweight US banks, energy and utilities. The average size of the holding is less than 2%. Positions are trimmed if they reach 5% or more of the portfolio, so reasonably good risk management there. And the companies are held for the long term for the benefit of compounding. Average holding period is 7 years. The investment trust likes to invest in 4 different types of companies, some that are having some exponential growth opportunities, some that are steady compounders, some where there's a potential for management to accelerate things, and some that have long cycle returns over an extended time period. This is a useful graphic representation of the portfolio where it's tried to put companies into different yields and different classifications, and we can see some of the real key compounding companies of the last few years in this central pillar here, with things like Nestle and Pepsi and Coca-Cola. So overall, I do quite like this portfolio. There's maybe 1 or 2 that I would change, but on balance, it's a pretty solid collection of companies. Scottish American has £95 million worth of borrowings against a market cap of around 10 times that amount, so it's not a bad level of gearing. The interest rates are also pretty low, so this scores quite highly for me. Unfortunately, I think that the property portfolio is a bit ropey. If there was a massive downturn, who wants to be holding a bowling alley in Taunton? Probably not me. If I was the fund, I would put more money into some core infrastructure instead, which would still give diversification from equities and a strong yield. The bond portfolio, as shown here, is fairly strange. There's some things that aren't too bad, such as Netflix and Tesco, but it has some very strange currency exposure that I don't necessarily agree with. I think it does have possible default risk, and it certainly has liquidity risk, and that I'm not sure it could actually sell some of these bonds prior to their 10-year ending. So I'm not really happy with this bond portfolio. Scottish American has a current dividend yield of 2.6%. It is a dividend hero, which means it has 20 plus years of growing dividends. It has recently been able to increase its dividend ahead of CPI, although that was when CPI was quite low, and it does have revenue reserves to underpin this dividend growth policy. Scottish American typically trades at a small premium to net asset value, and this is not uncommon for investment trusts where they have fairly reasonable fees for the activities they undertake. If you do see a rare discount to net asset value, then that is a possible buying opportunity, and the investment trust does have a good discount management policy where it potentially buys back shares if the discount persists for too long. Comparing Scottish American to Baillie Gifford Global Income Growth, its equivalent fund, we can see there's really been no benefit from Scottish American having gearing property and bonds, but the investment trust does have a higher yield even though the total returns are pretty much identical. Scottish American compares pretty favourably to a favourite fund of mine, which is JP Morgan Global Growth and Income. However, when it's compared against the ETF Wisdom Tree Global Quality Dividend Growth, the story is quite different, and the ETF with lower fees has some pretty decent outperformance over a 5-year period. If you're interested in learning more about this ETF, I'll put a link in the top right here, and it'll also be in the description. You can research Scottish American at the Association of Investment Companies website. I've got the address here and a screenshot. Most of the research that I've done came from the report and accounts. My conclusion on Scottish American is that the key strengths are, well, it's got dividend growth ahead of consumer price index. It does have lower fees than comparative active funds. There's discipline around the portfolio, which I didn't really see in Scottish Mortgage because we've got 5% cap, and we do have some great companies in the portfolio, and the total returns are slightly ahead of the global benchmark. Unfortunately, the weaknesses are that the dividend yield is below 4%. It's not enough to live off, and so if you had this in your portfolio and you had retired, you'd still need to probably sell down some shares to generate enough money to live off. It has some pretty shonky bonds, and the property portfolio is really not to my taste. I prefer if it held more infrastructure, and I did find a lower cost rule-based exchange traded fund that had stronger overall performance. Don't forget to subscribe and ring the bell so you get notified when I upload new videos, which is every Saturday. And also you can learn more about Wisdom Tree Global Quality Dividend Growth in this video here.